Hello everyone. Today's video we are going to look for solvency ratios, and this will be helpful for the students as well as for the investor, those who are starting from the investment from the beginning stage. Okay, this will be very helpful for them. Here we are going to look for the major ratios which is helpful for taking decision and what is a simple meaning of each and everything, and we are comparing with the Indian stock market as well as for the UAE stock market also. Okay, with the real examples. Let's see. Okay, with the help of this agenda, valuation ratios, profitability ratio and liquidity ratios and all we have seen already. Okay, suppose some newcomers which you are looking for solvency ratios right now, what you need to do, you have to go and look for those ratios and you can gather for the knowledge. You can come here for learning these things, that will be more helpful to you. Okay, so for right now we are going to look for the solvency ratios. What is solvency ratio? Okay, solvency ratio, otherwise call it as leverage ratio. Okay, that's two name will be there. Either we can say for solvency ratio or else we can say for leverage ratios. Okay, the meaning of solvency in a sense, we are having a power to identify to meet the long-term obligation or not. Okay, if you're getting a loan from bank, okay, for an individual point of view, you have a ability to repay or not. With the help of this solvency we can identify. Okay, in a finance term we can say for solvency. In a normal simple English we can say for redeem, okay, pay off, such kind of simple term we can use it. Okay, for a financial perspective we can use for the solvency. So this solvency in a sense, we are going to repay for our loan, for our borrowed fund. Okay, that ability only show for this ratio. That's called solvency ratio. Okay, so that is what the meaning it is showing over here, to assess the company's ability to meet its long-term financial obligations. Okay, so not for the short term, it's a long term. Long term in a sense what? Short term we can consider within a year. Okay, that means for the 12 month, within 12 month. For long term in a sense what? It's a more than 12 month. Okay, whatever will be available, that's more than 12 month, you can consider as a long term. Some people consider for 2 years and 3 years like that. Okay, if you're looking for solvency ratio, okay, for the investor, you are having for 10,000 dirham or 10 lakh or 1 lakh, you are thinking that I'm going to invest in a market, whether it is Indian market or UAE market. For long term only I'm looking, in a sense you can go for solvency ratio and you can look at. Okay, so this solvency mainly focus for the debt. How much debt company possessed with the help of comparison of asset. Okay, for that purpose only we are looking for the solvency, and it's showing the purpose. It has mentioned to know the company fiscal health. Physical health, otherwise we can say for financial stability. How company is financially stable for that particular industry. That's the purpose only we are calculating this solvency ratios. And if you're looking what are the types available, in a sense debt equity ratio and debt to asset and interest coverage. Okay, major these three types or common types, okay, for the solvency ratios. So that is what we are going to look over here. Now you can understand what is solvency, okay, what is the meaning of it, and what is the purpose we are looking this one. Okay, in terms of creditor point of view, they will look for the physical health. What we will check, the company is having a financial stability or not with the help of the solvency ratio. Okay, what is the meaning of leverage? Leverage normally we heard about for future market, right? In a finance term we use the word called it as leverage. Okay, the meaning, simple meaning in a sense, it's like a borrowed fund. Okay, for the future market some investor they will use it. They are holding for that is a few amount, that is a less amount, but they can get it for leverage of 5x and 10x, 20x like that. They don't hold the money with hand, but they are borrowing from respective exchange and they will do for trade and they will get for capital gain. Okay, so for that purpose they will use the word called it as leverage. Okay, I think you can understand the terms of everything. Okay, now we can move on to debt equity ratio. Debt, what is debt? Whether you are paying, if you're getting a loan, okay, you're getting a borrowed fund or loan, these all terms are unique terms. Okay, in a company perspective, in finance perspective, they will say the word called it as debt. In a gentle human being perspective, we can use the word called loan, okay, or borrowed funds, like that, okay. So these all terms will be same only. So from here, we are going to check the debt the company is having a ability to repay to the lenders. That is what we are going to check with the help of debt equity ratio. How much debt a company has compared to its asset, okay. So we are going to check how much of asset a company is hold and how much of debt they are getting. Say for example, in individual point of view, you can take it. If you're getting a loan, they will check it. What's your income? How much of asset you are holding? Okay, if you pledge in your land properties or something like that, you will not get for the current market value 100%. You will get it for 75% or 50% only, right? So as the same way, for banks or financial institutions, they will check for the solvency ratio of particular company. With the help of this debt equity ratio, it will show you the company is holding more liability or less liability while compare with the asset, okay. So this is a formula for calculating debt equity ratio, that is total debt or total liabilities. Some balance sheet that's available long-term liability and short-term liability, like that, okay. In something available current liability, non-current liability, okay. So based on that, you need to calculate this debt equity ratio and divided by total shareholders equity. Two formula will be available for calculating shareholders equity. How you can calculate? Total asset minus total liability. From here, it's not available the word total, okay. So from here, it's available total shareholders equity, in a sense that is a total asset minus liability, okay. You can consider all the asset, current asset as well as for non-current asset. Same way, liability, current liability as well as non-current liability, that's a total liability. Suppose these information not available in the balance sheet, you can use this formula, paid up capital plus retained earnings, okay. Based on this formula, you can derive the figure of debt equity ratio. So once you are getting the result, what is the decision you need to take it? In a sense, the debt equity ratio is coming below 1, it's good, okay. If it is above 2, it's riskier, even though you need to compare with the average. What is the meaning of it? If it is below 1, it's good in a sense what? The asset is over than the liability, okay. The asset value will be higher than the liability, okay. Your asset, if you are holding the asset for 50 crore, okay, you are getting the loan for 20 crore, in a sense what? Your asset value will be higher while compare with the debt figure. That's the thing for below 1, that's good. Now we can compare with the both the markets. Your debt equity ratio above 1, right? So such cases, what we need to do, we have to compare the industry average which has been listed in which exchange you need to look. It's listed under Dubai Financial Market. So how many bank listed over there, put for the average, okay. With that average, it is coming around 1.1 or something like that. In a sense, you can adopt, no issue, okay. So if it is above 1, such kind of cases, you need to compare the industry average, okay. What's the impression I have given here? More than that, if there is a opposite result it's coming for any respective company which you are choosing, what you need to do, you need to check it for respective average, okay. That's the thing, okay. Now we can compare for Indian market. I have selected the company name called Hindustan Unilever Limited, okay. From here, you can check a debt equity ratio will be 0.03. That's below 1. It's good, okay. With the help of this debt equity ratio, in order to take a decision, in a sense, this 0.03 will be fine. You can take a decision of it, okay. This is a way you can look for particular company in UAE as well as for India, okay. If it is above 2, in a sense, it's riskier, means more liability, okay. So how we can expect the company will produce for the profit and all, okay. That's the thing. Suppose if it is available for above 2, okay, and you need to check it for the industry average. Industry average is also same thing, in a sense. In some cases, 50% of chance you can adopt for those things, okay. And next, let's see for a debt to asset ratio. What is debt to asset ratio? How much of percentage of the total asset of a business or financed by creditors or by borrowing from outside sources? In a simple real life example, I will tell you, you're having for land document, okay, it's a value of 50 lakh, but you require for the amount only for 25 lakh. Such cases, you're approaching for a bank, they are telling that, okay, with this I will provide you for 40 lakh. But what you will say, I am not required for 40 lakh, I required only for 25 lakh. So you are pledging for 15 lakh document to a bank, you are getting for 25 lakh. So how much, what will be the percentage? The 50% of loan only you are getting, right? As the same scenario over here. With the help of this debt to asset ratio, it will mention how much of debt they are getting while compared with the asset, okay? The percentage they are assessing with this, okay? These all interrelated only. Which one? Equity as well as debt asset ratio and all, okay? So how we can calculate this one? Debt to asset ratio equal to total debt divided by total assets. Total debt I already told you in the previous slide. What is that? Short-term debt as well as for long-term debt. As well as for total asset in a sense, same. Current asset, non-current asset. Intangible asset or intangible assets. Okay, all those things you can add over here. From that you will get it for particular ratio. Okay, so if the ratio coming below 1 in a sense, it is good. Okay, it is good means what? The asset will be higher, and if the company is getting debt will be lower. Okay, if it is above 1 in a sense, liability is higher than the asset. That's a meaning. That's a meaning for above 1. That's the reason I have mentioned here for riskier. Suppose a respective company, the figure showing for 1. Okay, 1 in a sense what? How much of asset figure they are having, how much of asset value they are holding, same value of liability they are having. That's the meaning of equal to 1. Okay. So as the same way, we can compare for the companies over here. Debt to asset ratio, it will be 0.01. That is below 1, it's good. Okay. So that is a thing we have shown over here. Below 1 in a sense, it's good. Above 1 will be riskier. So now we are checking for this one, Dubai Islamic Bank. Debt to asset ratio will be 0.13. This is also below 1, it's good. Okay. Next one for interest coverage ratio. A company is able to pay interest on the outstanding debt obligation. Same example. As an individual taking for a personal loan, they will check it on monthly basis, a respective person able to pay for their interest or not. Okay, principal plus interest. They will check for last 3 months, last 6 months salary along with the which company you are working and what is the position of it. After that only they plan to provide for the loan to you, right? Same here for the company also. With the help of this ratio for the creditor, who's a creditor? I already told you it's a banker or financial institution. They will check it for interest coverage ratio. If it is above 1.5, in a sense average, okay, if it is 2.5, mostly the financial advisors, they will suggest for interest coverage ratio, it's around 2 to 3, and in a sense it will be good, they will suggest. Okay, so if they are looking interest coverage ratio will be above 3, it is well and good, immediately they will get a loan. Okay, from the bank. So they will look for the interest coverage ratio, then they will take a decision of it whether they can provide a loan to particular company or not. As an individual, how we can check it in a sense, as how the creditor will assess for the company, as the same way, general individual also we can assess it, it's good or not. So this one, how we can calculate in a sense, EBIT. What is EBIT? Earning before interest and tax. Okay, divided by interest on long-term debts. From here, we need to take it only for long-term debts. We should not take it for short-term debts. Okay, with the help of that, we can calculate. And from here, in the UAE market, UAE market, interest coverage ratio is not available. So with the help of that formula, we need to calculate. Okay, so now we can go for Indian market. The interest coverage ratio, it's available 42.7. It's above 3. Well and good, right? So what's the decision we can take it? It's a good company. If they are approaching for a bank, immediately they will get a loan offered by the help of this interest coverage ratio. That is what the decision of these things. Okay. So suppose if it is low or something like that, you can compare with the industry average. See here, it's available industry average 50.97. We'll compare with 50.97. It is low only. But overall, if you're looking in a sense, it's fine, right? Interest coverage above 3. So it means 42 is well and good. Immediately they will get a loan from the bank. Suppose if they are approaching. Okay, this is a decision you need to take it with the help of this interest coverage ratio. And normally the people will ask, somebody look for liquidity ratio earlier in a sense. Surely they will raise a question of it. What's the difference between these two? Okay, the thing will be explaining debt only. Okay, the obligation. Debt obligation only explaining both the things. But liquidity ratio will be a short term and solvency ratio will be a long term. Okay, if you're a short term investor, look for liquidity ratio. If you're a long term investor, you can look for solvency along with the liquidity ratios. That's the thing difference. Okay, that's the main difference for these. And for liquidity ratio, if you're looking in a sense, risk will be low. In terms of solvency ratio, risk will be little high, right? So anything may be happen for 2 years and 3 years period and all those things. But if the person having a patient, surely they will get a profit of it. Okay. So if you already looked for this video for liquidity ratio video, which I posted earlier, then you have raised for this kind of query. Okay. So right now, the people, you can list down below which company is debt free. Those who are an investor, you are looking for my video right now, even for Indian investor or for UAE investors. whatever company is debt free, the company which is not getting any loan from anywhere else, the company did not get any borrowed from anywhere else, debt equity ratio will be 0. Just you can list it below, even from UAE stocks as well as for Indian stocks. Okay. As the same thing, this is what the decision you need to take it, and this is only for the education purpose has been posted this video, and this will be helpful for even students as well as for investor also. Okay, you can do your own research and choose for the particular stock. Okay, suppose this video will be helpful for anyone, thus you can give a thumbs up, and suppose if there is any queries available, you can leave a comment below. Okay, and share to your friends. Thank you friends, thank you for watching this. Bye.